went
smoke,
up.
come what may.
No, I mean, the only way you quit is because you want to quit. I mean, prices have gone up, not recently, but they've gone up over the last 10, 15 years. But I think India is one of the few countries where cigarette volume sales are still growing. In the US, cigarette volume sales are down. I mean, it's like a 45-degree angle for the last 50 years.
Wow.
Anyway, I mean...
But I guess it leads to a bit of an overhang. You don't know. And like one of the guests also said, then there's a budget coming up. Now they're going to tinker with that,
It increases uncertainty, but I mean, we'll see. But 2.5% lower. The other one, of course, is footwear. I thought Mangalam will mention that since he's as he calls himself, a sneakerhead. We'll talk about that as well. Metro brands. I mean, all these quote-unquote premiumization plays. And I think we'll have to sort of get around that as well. 100 points higher on the Nifty and a 200-point pop on the Sensex is what we have. This is the first rate coming up on the Nifty and the Sensex. Bank Nifty is up about 0.25% as well, 52,277. What else? Mid-cap index is up about 0.6%. So last week, mid and small caps outperformed massively. Yesterday, they outperformed the Nifty and the Sensex, and this morning is where I think the start at least is more in the broader markets. The Nifty heat map coming up as well. I think you've got a few stocks lower. ITC is there in the red, but the majority of what is starting is up in the green at this stage. 1,200 stocks are higher and about 400 stocks are lower, although this is still under 1 minute of market open. Let's get to stocks. Surabhi.
Absolutely. Just to complete this GST issue before I go back to the Nifty, look at a stock called Vedant Fashions. This is the company that runs the Manyavar brand. And now, if luxury is defined as clothing above, say, 15,000 rupees or 20,000 rupees, it'll impact Manyavar because their average selling price is usually on the higher side. It's wedding wear. So Vedant Fashion already down almost 5%. Watch out for this one. Even VST Industries is down 1.5%, as is ITC. So the GST impact is playing out on individual stocks. Okay, let's come back to the Nifty. Titan is slightly lower as well because, again, this is linked to GST. There is some talk about higher value or higher priced watches also being taxed in a higher way. But what's the cutoff threshold? We have to watch out for some of these things. What else is negative in the market? Bharti Airtel is slightly lower. ICICI Bank, Infosys, these are stocks on the lower side as well. However, offsetting that are names like JSW Steel, 2.5% on the higher side. Tata Steel, ONGC, some of these commodity companies are doing well. Shriram Finance is having a good morning, 2% higher. Adani Ports is up and about. HDFC Bank is doing well. Actually, the Bank Nifty is holding up the market, you'd have to say, with a gain of almost 0.5%. SBI, HDFC Bank, a lot of these bigger names. Otherwise, it's a little flat. But yes, some of the steel makers are, really shining bright. And then there are the banks, which are doing well. Nigel.
Well, that's right. Indegene, that stock is one of the big losers because of that large trade that had to take place. So that one's down. GST tinkering is weighing on ITC, Varun Beverages as well. Both those two stocks are lower in today's trading session. In terms of stocks that are doing well, you have Solar Industries, massive order win. Well, that one, in fact, is one of the top gainers that we're seeing today. So keep an eye out on that one. Arcade, another one that listed in the last 1 year or so. Volumes rather high, unusually high actually. Arcade is the one that's up close to around 8%. So keep an eye out on that stock as well. A few more gainers should come up for you on the screen. You have Genus Power that's moving well, large volumes. Swiggy will be reporting its numbers. Some optimism building in there. So that stock is well, making a close to a fresh high that from the time it's listed. Ola Electric is another one that's doing quite well. So quite a few of these names are doing well. I'll tell you what, the Nifty gapped up with a gain of close to around 100 points. That was a bit tricky for the bulls because you can't chase that sort of an opening. So now the resistance for the day comes in at today's high, which is closer to around the 24,400 odd mark. That's the important resistance mark. We'll have to get past that. But after underperforming for the last couple of sessions, you have the Nifty Bank that is now up close to around 0.5%. And it's outperforming for today.
Absolutely, and we'll see if it's got more in it. But we've got a 30-point gain now on the Nifty. Policy Bazaar is another one which is up about 2% or so, and that is looking at about almost 2,000 rupees. It's taken a while, Policy Bazaar, to come back to take out the earlier highs. Remember, I mean, it went into a bit of a flux once they said that they wanted to get into manage healthcare kind of operations. and there was buzz whether they're going to get into hospitals, etc. Stock had fallen sharply to almost about 1,500 odd rupee levels, back at 2,000 now, Policy Bazaar, and they've got large volumes as well. Cochin Shipbuilders, 5 days back, 5 sessions back, stock was at about 1,260. Stock's at 1,725 in 5 sessions. So that's a big move coming through. And I think even names like Mazgaon and Garden Reach have recovered quite nicely over the last 5-6 days. Inox Wind, I think there is news flow, which we highlighted, 6% on Inox Wind. It's got huge volumes for this point in the day. Torrent Power, I think we did highlight earlier. A stock called Black Buck, which is recent listing, is about 5-6 days old. It's down. It's up about 1%, but was a circuit up yesterday. Black Buck. We've got pre-call. Vivek had highlighted. Asud had highlighted the acquisition there. Manappuram is up about 3.5%, so it's coming up with some decent kind of gains. EPAC is back up 5%. Was up 5% yesterday as well. So broader markets are doing very, very well at this stage. There's a small company called Wanbury. It's coming up with some volume, so just want to highlight that as well before we look at other stuff right now.
Just mentioning Swiggy as well. I mean, the start was so quiet for this company, right? It's listed, started reporting its first numbers today after listing, and there's so much excitement. Anyway, it's sort of picked up in a nice fashion post-listing. The stock's done really well, and the anticipation is that maybe they'll have a very positive commentary to share today after those numbers.
And there are 2 large trades that have taken place. TBO Tech, that's a newly listed company. So massive volume out there, explains why the stock is down close to 6%, some change of hands taking place there. And Zentech is the other one that's been a big outperformer. That one's down close to 5%, but that one as well, a large trade out there. We'll try to get in both those 2 managements and find out more with regard to who are the participants on both these 2 names.
I think Mangalam was talking about beverages, right?
Yeah,
I mean, higher GST. Varun Beverages down 3.5. It's the second largest volume traded name at this point as far as open is concerned. Gautam Shah is now joining us, founder and chief strategist, Goldilocks Premium Research. Gautam, good morning. Good to have you with us here. Thank you for your time. So have we put the correction behind us, Gautam? What's your sense?
Good morning, Prashant. Well, looks like. I think the manner in which indices have handled adverse news flow, and we've got a lot of it in the last 6 weeks, I think is enough testimony that the markets are internally strong. I think the GDP numbers, which pretty much shocked everybody, and everybody was concerned how the market is going to handle it on Monday, which was yesterday, and the fact that we closed in the green just tells you that the GDP number of last Friday was discounted over the last 6 weeks. And that's probably the reason Indian markets fell 10%, while world markets remained quite strong. So I do believe that the market could have formed a bottom at the recent low. We were anyway looking at some serious support around 23,300. That seems to have worked. The price action has looked good. The screen has looked good. A lot of stocks have come back very, very strongly. And I think the final nail would be once the Nifty gets past that 24,500 number, which I think is the final resistance. And once we are above it, I think you can confidently say that the uptrend is back in track. So I do believe that this breakout is coming. December is usually a soft month, a relaxed month. And given the data points, it does look like that breakout is coming. And once confirmed, you could see the Nifty move towards a level of 25,200. But I still believe that this is a stock and a sector-specific market. Don't anticipate something serious happening on the Nifty on the way up or on the way down, because I think there is a battle between domestic money and the economic slowdown, which is being debated and talked about. But the overall trend and trajectory is still up, and I don't think we are going to make new lows anytime soon.
Okay, that will be great. To hear for a lot of people out there who've been reeling under this correction, Gautam. Just confirming the levels. Above what level of a breakout do you see the Nifty heading to 25,200? What's the watch point now?
See, as I said, we've already rallied about 1,000 points from the recent low. And I think the moving averages, and based on a number of studies, 24,500 for us is the line in the sand. Once we are past this number, I think the bulls will take greater control over the setup. And I think that's when the momentum is going to get better. Because in the last 6 to 7 days, the market has still confused a lot of market participants. But I'm tempted to believe that the market will find support on every dip, like what it's done in the last 2 weeks.
Okay, so 24,500, if that's crossed, then, well, the ship is going higher. Got that. So what's the trade? What's the best long side trade? Not from a 1 week or 10-day perspective, but I'm saying next 2-3 months then.
Well, yesterday we released a big picture report wherein we made a very clear point that the manner in which bank Nifty, held out in the last 6 weeks, while the Nifty corrected 10%, is not something we've seen in the last 3 years. So there is a clear message from the market that banking is an outperformer and is likely to do well. And I do believe that the bank Nifty breakout above 52,500 is coming. If that were to get confirmed, you are likely to see bank Nifty hit new highs much ahead of the Nifty and much faster of the Nifty. And our working target for the banking index is about 55,000. The fact that you have HDFC Bank at lifetime highs, whereas the Nifty is still 8% away from its lifetime highs, is a major takeaway in itself. So I think banks and IT are the real opportunity. I do see across the board strength in banks. And the IT index, which is already trading at lifetime highs, I think has some excellent charts, great momentum, possibly a 46,000 number on the IT index near term and a 50,000 number over the medium term.
Okay, hi Gautam. Good to hear you today. You're sounding quite pepped up, and you believe that the market has a higher likelihood of moving up than moving down. So that's good news. But you mentioned a couple of names. HDFC Bank, it's come out of its slumber and now, in fact, it's gunning for higher levels, which is great news for the banking index as well as for the Nifty, because that was, not able to perform in the recent past. What levels are that one going to test? And what about Reliance Industries? At the start of the series, we had a couple of experts who joined in, and they were talking about the short positions at the highest levels we have seen ever. Where is that one headed, Reliance Industries? Because it's been an underperformer for past 6 months.
I think the underperformance will continue. And in fact, if somebody took a pair trade of long HDFC Bank and short Reliance, I think that trade has worked wonderfully in the last 6 months. In fact, that's been our stance. And the fact that the open interest on the short side is so high in Reliance Industries, and the reason why that could be, see some short covering just on account of that, I think that's not the right way to think about it. Reliance remains an underperformer, and I think it's going to remain this way for many more weeks to come. I don't see the outperformance returning anytime soon. Whereas HDFC Bank has handled a very difficult period really well. And I think this market has moved from growth to value. And many of these top stocks which have done well in the last 6 weeks have typically become, have been value stocks. So I do believe that over the next few months, we should see an HDFC Bank easily move towards a level of 2,000 and maybe do plus. And apart from HDFC, we also like SBI, where we feel that a 20-25% up move is coming, along with ICICI Bank. So the key message is, in each of the major sectors, stick to the big boys. And apart from the banks, I think if there are two dark horse sectors which I think can really outperform over the next 3 to 6 months, that would be real estate and metals. Real estate coming out of a 6-month consolidation, and metals has been at the lower end of the range. And I do believe over the next 1 year, it could do something special.
And this morning, I think we got this call from UBS as well on real estate. And of course, metals is something else you're pointing out to right now. NTPC Green, by the way, I'm just highlighting that it was not there in the mix. The stock will come up on your screen. It suddenly shot up to being the second largest volume-led gainer, right behind Swiggy. Swiggy is given up 4% from the day's high. NTPC Green is up 5%. It started kind of flattish and then picked up quite a bit through the course of the initial few minutes or so. Gautam, in metals, what exactly do you want to name names?
If you look at the last 4 to 5 months on the metals index itself, 86 has been a sort of a floor and 10,400 has been a ceiling. We have been oscillating within the same. We've handled a lot of news flow from China, and on account of that, we've seen a lot of volatility. But the charts are clearly very well placed, and I think the new wave on the upside is what metals could see over the next 12 to 18 months. You'll have to play slightly long term and not short term. And I think some of the top stocks like JSW Steel, JSPL, Hindalco, Tata Steel, in fact, the entire basket, even a Nalco, which has been such a big outperformer, we like the entire basket, and not to forget Vedanta, which I think is also at a important medium-term support. So the idea is, if you want to play a basket in metals over the next 12 to 18 months, I think you are going to grossly beat the Nifty, and that's probably been our stance.
And what in real estate? Just 2 or 3 top ideas, best bets?
See, real estate, when the breakout happened a couple of years back, we always believed that this is a structural story, because what I heard on the ground and what I saw on the screen, I think there was a clear match, which was good to see. 6 months back, everything got a little out of hand. It needed a nice long consolidation, which happened. DLF remains our top pick, and I think at levels of 830, 40, there is not much to lose, and there is potentially 30 to 40% to gain. Again, in all the sectors, I'm sticking to the big boys. So I'm still very comfortable with DLF, Oberoi Realty, and Godrej Properties. And I expect these three stocks to deliver serious returns. And I also expect the real estate index to make new highs over the next few months.
Okay. You know, Gautam, in all this, I was just going back to a conversation we were having with a global guest earlier on in the show. The thing is that, and it's great to hear that you're finally, sounding optimistic on the Indian market. But I guess internationally, the big trade still seems to be buy America, everything America, right? Well, the dollar higher, equities higher, etc. So how do you see the next, say, month or two till we get into full-fledged back into January play out? Will it still be primarily U.S. market driven? Yields have now started cooling off. The dollar is still pretty strong. I mean, can India move higher now in step with the U.S.? Because till now it's been an absolute underperformance last 2-3 months.
Yeah, I think that's a great point. In fact, in one of our reports yesterday, we shared the view that if you look at the last 10 years of data, the Dow and the Nifty have pretty much moved hand in hand. And it's just been top in the Dow leads to a top in the Nifty, bottom in the Dow leads to a bottom in the Nifty. It's happened for the last 10 years. We put out a lovely correlation chart there. For the first time in many, many years, in the last 2 months, you saw the Dow making new highs and the Nifty going through a 10% correction, which I think baffled everybody. And I do believe that the internal GDP numbers was really responsible for this underperformance. People talk about FI selling and valuations and all of that, but I think that was getting priced in. Now it seems that this disconnect, which was there for a short period, is going to correct. So Indian markets will move higher and US markets will remain steady, because when I look at the top stocks in the US and the fact that the Russell 2000 in the US markets have gone to hit new lifetime highs, which I think is an event in itself, because everybody was complaining that the top stocks were doing well and the Russell 2000 was not doing well. So I think India and US going forward will move hand in hand, and the US market setup remains positive, and I'm looking at another 10-12% upside for all the headline indices there.
Okay, another 10% upside, right? Even in the US market for the key indices. All right, so good times. Perhaps Santa Claus indeed is coming to town. Thank you so much for joining in, Gautam. Pleasure having you on the show as always, and look forward to more conversations soon. Let's now quickly do a check on how the market's shaping up before we move to our next guest. It's steady, about 20-23 points higher on the Nifty, so not too much of a problem. It's a great morning for mid-caps once again. The outperformance really is in the broader market. So that's how we're looking at this Tuesday morning setup. With that, let's now put the spotlight on the digital banking landscape in the country. There seems to be a lot of competition, a lot of new fintech players coming in. Incumbents like big giants, big private sector giants, as well as the PSU giants are looking to up their digital game as well. HDFC Bank has also set up something called the Smart Hub Vyapar app. Clearly, they are trying to sort of attract more of the mid-market merchants onto this digital platform. So what are we looking at over the next 1 year or so in the fintech space? What is the growth outlook? To talk about this, we have with us Mr. Parag Rao, Country Head Payments, Liability Products, Consumer Finance and Marketing at HDFC Bank. Thank you very much for joining us, Mr. Rao. Great to have you on the program. And so the sort of thought process behind having this conversation is to really understand how large incumbent banks like HDFC Bank, how are they turning on the competition to a lot of the fintechs that have had an early start in terms of digital adoption, whether it's payments or onboarding, newer customers. And all this is happening against a backdrop of a regulator watching with a hawk eye and pulling up banks, pulling up NBFCs and fintechs for whatever lapses that there would be in the digital platform. Your opening thoughts, sir?
Okay, fine. So I think the thought process is pretty clear. One is at an economic front, as you see, the consumption is growing on an overall basis. We're growing. We've got a great outlook over the next many years for consumption growth and GDP growth. That's number one. As a very large bank, we are in the midst of driving a lot of, our products drive a lot of this consumption-based growth for India. We have the entire suite of financial service products. We are the market leader in acceptance in the acquiring business, in excess of 40%. The products which these small and medium merchants actually require in the financial services space, the entire suite we offer. We are the largest payment services provider in the country as a bank. And so therefore, also when you look at our retail presence, we have amongst the largest branch networks in the country. We source a lot of our financial services through the branches. There's a deep connect with rural and semi-rural India. All of this makes for 2 or 3 great assets. So we know our customer. We've got great distribution across the length and breadth of the country. We have a full suite of products. Come in digital. In today's landscape, I won't go through the entire landscape of how the digital India has grown, but suffice it to say that customers and even merchants and MSME require digital solutions on top of their conventional solutions. So banking is now taken 2 forms. There's the conventional banking, there's the face-to-face banking, there's also digital banking. And banks need to continue offering digital solutions to cater to the many needs of the customers, including the newer set of customers.
Parag, hi, good morning. And good morning, Prashant here. Good to see you again back in the program. Apologies to interrupt you there. Can you hear me? Can you hear me, Parag? Good morning. Prashant here.
Sorry, just lost your connection.
Can you hear me?
Sorry. Yes, I just lost your connection, yeah.
Okay, but we're back on, right? Sorry to interrupt. Sorry, paucity of time, so and apologies to rush you along. But it was a good summary. So just a couple of points, Parag. So do you believe, first of all, so credit growth has come off across segments, not just for you, but for the entire industry. I mean, everything has come off compared to where growth rates were 1 year ago. We recently got the GDP growth numbers. Many believe that a lot of this has been driven by regulatory measures. I mean, for example, fintech as a space, etc., is largely...
I'm sorry, Prashant, to interview. Sorry, I'm not able to hear you clearly at all. I'm sorry, Prashant, connection is too poor.
Okay, I think what we'll do is, Parag, we'll just get that connection back on, and we'll have you back on in just a bit from now. Let's just take a quick look at the first... a couple of stocks, actually. So Swiggy is, of course, top of the list in terms of gainers, 4%. And NTPC Green now is the big mover. 4% earlier when I highlighted 6.5%. I think it was up almost about being 8% in the green. And of course, there is some of the other stuff which is all coming up as well. You've got BLS, that is Bombay, London, Singapore, the visa company, 4% higher. Zuari is up 4%. Indoco is up 5.5%. Acme Solar is up 3.5%. And of course, some of the other stuff like, EPAC durables, etc., we highlighted earlier, and they continue to be going pretty strong as well. So more names and more stuff which is moving. Premier Energy is down 2.5%. That's a recent listing. It's well owned and well tracked. So that's got some large volumes as well. And ITC is still there with about 2.5% cut. Varun Beverages is down about 2% right now. So, it's on the Nifty. It's a bit of a slower kind of start, but actually it was a fast start. Now it's a little slower. 35 points is all that the Nifty has on it. Let's actually revisit that GST story with Mangalam, and of course, implications for cigarettes, but also footwear. So, Mangalam, I was wondering earlier whether you would bring that in. Go on, Mangalam.
For footwear, the thing is that unfortunately there are no listed companies, not many in the listed universe that would get immediately impacted, because India as a market is more value sensitive. So majority of the footwear is still sold under 500 rupees per pair itself. So 10,000 rupees to that extent becomes a very small universe itself. So might not be as big an impact on the listed players, but I'm sure for the kind of shoes that you and all the others buy, maybe a little more than that. For me, not a problem, because I usually buy sport shoes, which unfortunately, are not any of these companies which are listed in India itself. Having said all of that, ITC is currently lower, largely because of the possibility of that GST incidence increasing from 28% to 35%. There are 3 possible scenarios what you have to look at, whether it is in lieu of the compensation cess or whether it's over and above that. If it is in lieu of the compensation cess, there are 2 parts to the compensation cess as well, which is one specific and ad valorem. What we understand is that the GOM has also sought an extension to this compensation cess itself. So let's look at the worst case scenario, where this is an increase over and above the cess as it were in its current form. So the total tax incidence would increase anywhere between 7 to 12%, and as a result of which the companies may have to take a price hike of anywhere between 3 to 5%. These are back of the envelope calculations. And if they don't take that, then there could be a hit on the EBIT to the tune of around 5 to 7% as well. Similar is the case for Varun Beverages. For a lot of these aerated drinks, it is excise duty plus that 28% GST. So that 28% turns into 35%. So to that extent, we would see an impact on their overall tax incidence itself. The companies usually, would be hurt a lot more in the beverages space, largely because India is a price-sensitive market. So a 5, 10, 15 rupee bottle cannot be sold at 16 or 17 rupees. So they'll have to manage that. So to that extent, there might be a slightly bigger hit on the EBIT. The stocks are lower. But again, because this is just a possibility and nothing formalized yet, these stocks have seen some recovery from the lows itself.
Mangalam, thank you very much for that. Parag Rao is with us. I think we've re-established that connection. Parag, apologies for that. Got you in a bad line. I hope you can hear me clearly. Prashant this side. My question to you is, do you think, as we head into 2025, some of the regulatory scrutiny, and 2024 was about RBI cracking the whip. Do you think, and that, of course, has also affected consumption, etc., because bank credit has tightened quite a bit. I mean, lending has tightened quite a bit. Do you think it'll ease off?
Okay. Well, let me put it that I think the changes or the introductions which the regulator brought in were, in my parlance, as you call, corrections. In a rapidly growing market, you see some aberrations coming up in some parts of the economy. Some of the actions taken by the regulator were more to correct it. I think the policy which the regulator is rolling out is pro-growth. Their thought is to really encourage growth, but then you need to ensure that aberrations don't happen in the marketplace. So some of these are corrections, if you may call so. So we look at it as imminent parts of the whole journey which we go through. Regulation is there to exist, and it's, I think, required. But outlook on growth is robust.
Right. Parag, got that. Another question. Unsecured has kind of slowed down quite sharply. I mean, it's not new. It's been happening for the last many quarters. As that has gone down, is the reliance on cards increasing, or do you see? I mean, that's like a proxy to unsecured lending. Do you see a pickup in that in spending on cards?
Well, yes and no. So cards is part of unsecured, it's part of the entire unsecured lending space. And on overall basis, if you see, I think there's been a slowdown in the growth of unsecured lending. So that's one part. Having said this, I think within the entire payment space, UPI today continues to demonstrate the highest percentage growth. The next is credit cards. Credit cards, is the way we look at it in the bank, is a natural extension to millions of consumers who are on UPI, and so that's a natural progression of the next product which you do. So we see credit cards also growing robustly.
So, Mr. Rao, if you could give us some sense that, let's say for HDFC Bank itself, considering digital is becoming such a huge channel now, if we talk about the lending side, whether it's unsecured consumer finance or whether it is even sort of reaching some of the MSMEs or the smaller companies, how much will the digital channel contribute? And similarly, if I talk about onboarding customers, because the RBI has been very cautious about digital-only loans or the digital-only customers as well. And in terms of onboarding more customers, what can we expect in the coming year for HDFC Bank per se? Some numbers or some rough data points will help.
Well, I can talk to you about the digitization percentage. Well, the entire MSME sector, if you see, is traditionally is all about documentation, physical meeting, contact point verification, so on and so forth. So we've been able to successfully digitize a large portion of the journey. Admittedly, I think it's not yet 100%, but depending on what kind of product, the digitization, let's say in the acquisition and the onboarding space, ranges from anywhere between 30-40% going up to almost 80%. That's helped bring a lot of efficiency, and it's also helped in your do-it-yourself kind of acquisition. So, for example, our Smart Hub Vyapar, which we talked about a little earlier, is our digital merchant app. Close to about 95% of the onboarding journey is digital, and you get merchants can just download the app from the Play Store and become merchants within a couple of minutes. They can start UPI transactions within minutes. So that's an example of the digitization journey which we've done. Similarly, if you look at, say, underwriting, which is more of a back-end function, anywhere between 40 to 50% today on an average across asset categories, both secured and unsecured, is completely digitized. In some cases, we go as almost as high as 90 to 100%, especially in our instant loans, which we...
No, so can you hear me? Yeah.
Yeah.
Yeah, so my question was more in terms of adding to the business, adding to the book, while of course digitization is a massive part at the back end of existing customers as well. If I were to ask you in a very simple way, if you look at the extent or the component of the business that's coming in X of branches, not physical branches, the digital only business. Now, whether it is in consumer finance, whether it is on the mid-market book, the MSME book, how much incremental growth can come in from the digital channel alone for HDFC Bank? Will it add incrementally 5% to the overall assets under management in these different segments, 10%? Just trying to get that sense.
Okay, so let me put it this way. Our book is very large, so, giving a percentage will sort of distort the picture. But let me put it on an incremental basis, depending on the category of building. So, for example, in credit cards, close to almost 70 to 80% of our incremental acquisition is digital. Depending on the asset category which you have, again, that percentage ranges between 25% to almost 40-45%. So that's the contribution on an incremental basis. And as the years go by, obviously, it will build up into our stock.
Parag, just one more question. I mean, you're the largest private sector bank, and you've got a real pulse, right, sitting in the center of all of it. Some concern that maybe, over the last couple of years, we had top-end consumption, which really propelled things, right? Bottom end, not so much at all. Now, the concern is top-end is kind of maxing out. The middle layer is not really firing yet. Maybe it needs some help. And the bottom end, of course, is where it is. Do you think we're at the stage where we need sort of help, either monetary-wise or fiscal-wise? Just wanted a quick word, Parag.
I don't think so. I think these are again blips which come in, aberrations which come in during the course of a high growth trajectory which the economy clearly shows. I think the infrastructure is in place. We see a lot of consumption happening, and it's been happening steadily post-pandemic. Some corrections would happen. You see that happening in many sectors. So I don't think this is cause for worry. We've got inflation under control. We've got the investments putting in both by the government and the private sector about starting. I think so. We've got a good trajectory of growth. We've got to ensure that some of these aberrations we take care of very well, so that you can ensure a smooth growth path.
Okay. All right. We'll leave it there. Parag, thank you very much. Short conversation. Had more questions, but out of time. Apologies for that technical trouble earlier. So that's Parag from HDFC Bank with a perspective on credit growth and everything else which is happening as far as banking is concerned. But time for Nigel, auto conversation. Bajaj Auto Management is with us.
Well, that's right. Let's focus on Bajaj Auto. The November sales numbers were in line with estimates. Exports surging close to 24% on a year-on-year basis for the month of November. The EV share as well has improved. To understand about the past quarter, both domestically as well as the exports, and how their share in the EV market is ramping up, we have with us Mr. Rakesh Sharma, the Executive Director at Bajaj Auto. Hi, Mr. Sharma. Good morning and good to see you, Ben. Well, first up, let's talk about the domestic market. Was the festive season as good as you expected? The broad feedback is that the two-wheelers actually had a pretty good time. Was it as good? If you could give us a growth on that front. And also if you could give us a hint about the exports, particularly Nigeria, as you have told us in the past, from 20,000, 25,000, 30,000 is what Nigeria did. Has it improved even from there?
Good morning. Yes, indeed, there was something to cheer about for the festive season. It started a little bit slowly, but in the second half of the festive season, particularly in the north, which is driven by Diwali, there was a real surge. And as a result of which, I think it has lifted the industry performance. First half, the industry was at about growth of about 6% odd, but now with this movement, I think we are looking at a nice 6 to 8% outlook for industry growth. And as has been happening, the top half of the industry, which is the 125cc plus segment, grew faster than the bottom half. It continues to do so. And I think going forward, that same pattern should continue.
Okay, and so domestically, 6 to 8% is what you're working with in terms of an industry growth for the year, right?
Yes, absolutely, at an overall level, but the upper half should be in double digits.
Got it. And what about your market share according to your calculations? And the earlier question that I asked you about Nigeria, give us an update out there. It's been looking better.
Sure. So I think as the dust is settling, because it's a very hectic period for registrations, etc. But as the dust is settling, our understanding is that the market shares the competitive positions are more or less the same. Our strategic focus, as you know, the focus area is the 125cc plus segment, where we hold a solid number 2 position at about 24-25% in that kind of a zone, which is about just a few percentage points behind leadership. So going forward with Freedom, which is the new CNG bike, and some new launches, particularly aimed at youthful segments in Pulsar, we will be trying to beat the pace of growth for the upper half of the industry. And Nigeria, like you asked, continues to show steady performance. If you will recall, I think September we retailed about 25,000 units, and October was about 33. And the retail numbers which just came in yesterday for November put Nigeria retails for us at 36,000. So that's a nice improvement. We hope to hold it steady in December, but December, by the end of the month towards Christmas, the market sort of shuts down. But innately, the retails are definitely showing a month-by-month improvement.
Okay, so the export market's also looking steady. You're looking to build on market share here in the domestic arena as well. Mr. Sharma, good morning. Speaking of market share, let's get to the hot debate on EVs, right? Because there, you've been taking big strides. And I think now Sudarshan tells us, our colleague, that now I think market share has moved up another 200 basis points. You're number 3, I think, right now in the pecking order at about 22% market share. Now, what do you see ahead? Next 6 months, will you take the number 2 spot? Are you gunning for number 1? And I ask you this in context of the competition. Ola has launched, a couple of new models, and they've come out with very aggressive pricing. Just tell us what would be the average price differential now, and whether this is at all a concern for you, and what's the market share you are hoping to have in EVs, say a couple of months down the line?
Yeah, I would rather look at the momentum. We were 13% a year back last November, and now we are 22%. But, and not so much at the numeric position, because really between the top 3, the difference is only of 3,000 units odd, something like that, And frankly speaking, the number 1 position is of value only when you have a strong competitive ratio. That drives the business value. Otherwise, it does give you a little bit of a bragging right. But what we would want to do over a longer term is not just aim for a numeric position, but really solidly enhance our competitive ratio, which hopefully will then put us in some kind of a commanding position in the industry. And sorry? Yeah,
the other point on this competitive pricing, I think the competitor is now offering products, I think, correct me if I'm wrong, 45,000 onwards. It's really aggressive. What does that do to the pitch?
Well, we have not seen the product. It's been flashed on the media, and what exactly that price includes and what are the total specs, etc. Before I make a comment about the impact of what competition is doing, one would really like to see it and understand it. Of course, it is very welcome to widen this industry if it is done on a sustainable basis. And certainly, we have a product pipeline beginning probably next 48 hours, we will be starting production of our new platform. And in the next 5-6 months, you will see solid reinforcement of our portfolio.
Okay. Mr. Sharma, hi, good morning. Prashant here. Now, this is a more industry level question. And this is true, this has been true for the last many months. There's a big gap between, Vahan data and the wholesale data for pretty much every player, and it is persisting. So, for example, in Bajaj's case, domestic registrations for the month of November were about 3.43 lakhs. Wholesales have come in about 2.41. And similarly, it's true for other companies as well. Could you tell us what's happening, and by when will this get corrected, or you think this is going to go on for some more time?
I think you see, what happens is that the huge surge which is there in 15 days of pre and slightly post Diwali, it is very difficult for the RTOs to cope up with that kind of a pressure on registration. So that's why the registrations on the Vahan portal spill over from the festive, which this year, as you know, was late October, and spill over well into November. And you will see that by the time the wholesales and the retail start to converge, one will have to really look at the December data. It's not anything unusual. You see, the whole process starts actually September onwards, when companies start to build up the channel inventory so that this spike can be serviced, right? It's a two-tier distribution in the two-wheeler industry, and the stock buildup takes time. So you will see wholesales ahead of retails by a fair margin in September also. And then there is this surge and they start to catch up. So really, it is this 3-4 months. One has to be very cautious about looking at limited time horizons and trying to extrapolate either for the company or for the industry on that basis.
So it's not as if, if Vahan data lags, wholesales or Vahan data, it's not one picks up and the other slows down. I mean, it's just bunched up sort of registrations happening together because of the
it's a lead lag effect, and sooner or later there will be convergence unless someone goes crazy and is just billing or doing wholesales, which I don't think is the case.
All right, Mr. Sharma, I would like to know about your new launches as well. And the Triumph, well, I think it did pretty well initially. But any new launches on that front, bigger bikes? I'll be personally very interested. So if you could update us on that. And I think the EV bike is something that you'll have spoken about as well. So how soon before we see that launch?
Yeah, so we did have I don't know if you missed it, that we did have a very nice introduction to the expansion of the Triumph range with what we call the Speed T4, which expands this modern classic portfolio now, which we have the Speed 400 and we have the Scrambler. What the T4 does is to, address the customer who wants to get into modern classics, which is the classic style with superior performance, but wants an easier riding and a friendly riding experience. And so we've got that covered with the expansion of the T4. The other thing which has happened significantly is that a slew of big bikes have been launched by KTM just about 2 weeks back. And these fundamentally address the adventure in the sports segment, bringing to the customer the absolute latest and the world-class bikes of KTM. And that was just done about 2 weeks back. The Triumph big bike portfolio, we are pressing ahead on it, and slowly but steadily, it is doing well and expanding. When you put all of this together, combined with all the kind of action on the ground to build motorsports, I think we are trying to engage with some fundamental drivers which will expand this market at the very top end.
Okay.
Mr. Sharma, when I want a bigger bike, I'm looking at the 650, 700cc plus, so that's what I refer to. But the T4, yeah, I mean, I recall you all did that a couple of months or so ago. But thanks a lot for joining in. You're sounding reasonably optimistic about business prospects. Next time around, we'll delve a little bit more into this EV vertical, in particular with regard to sourcing of sales as well.
Nigel, just want to mention, look at the bank Nifty.
Yeah.
The Nifty is quiet. The whole trade is on the hopes that there's a CRR cut coming on Friday. That would be my sense. You just heard Rajiv Anand rally behind that possibility as well, saying it would be a huge welcome relief. And a lot of economists that we've been speaking with, Lata sort of had the same view at the CNBC-TV18 Citizens Monetary Policy Committee as well, that maybe not a repo rate cut, a CRR cut would be a direct way to inject more confidence, liquidity into the markets. And maybe that is what's powering this move on the banking side. More on this in just a bit. We'll take a break, come back with markets full throttle and get you a lot of the interesting stocks to track, plus some trading ideas with Mitesh. Welcome back. Let's quickly revisit the big news on GST. We've got Tim C back with us on the proposals that the GOM could be taking to the GST Council. Tim C.
Well, yes, as you rightly said, the group of ministers on rate rationalization formed by the GST Council is likely to have prepared its final report. They met yesterday evening in New Delhi, and the consensus that they have arrived at is that there should be a new special rate added to the 4-slab structure of GST of 35%. But this 35% should be applicable only on tobacco and tobacco products and aerated beverages, for making up for the potential revenue loss that the council and all the states are likely to face because of several rate rationalization ideas that they have proposed. There are about 148 items on which they propose rate rationalization, along with the additional items of health insurance and life insurance premia. Now, just to begin with, what are these 148 items that could have been in this list? Firstly, ready-made garments. They say that it should be based on the price points, the taxable limit. So any ready-made garment below 1,500 rupees should be taxed at 5%. Above 1,500 till 10,000 rupees should be taxed at 18%. And any ready-made garment costing more than 10,000 rupees per garment should be taxed at 28%. Similarly, they propose brackets for watches, for luxury handbags, for footwear, for cosmetics, that these items should be taxed based on their pricing, considering that the luxury bit should be taxed at 28%, mid-segment should be taxed at 12 or 18%, and lower segment should be taxed around 5 or 12%, depending upon the pricing. That is what their suggestions is. Apart from that, they say that there should be a massive rate reduction on common use items, on the items which people like you and me use daily, say exercise books that our children use, should be reduced from 12% to 5%. Similarly, bottled water, which comes in a can of 20 litre plus, should be reduced to around 5 and 12%. So all these suggestions have been packed in a report which will be presented to the GST Council on 21st of December, which is slated to meet in Jaisalmer. So all eyes there. And yes, another break that they have proposed, that is a separate panel on health insurance and life insurance, is that when it comes to life insurance, pure term life insurance premia should be completely exempt for everyone from current 18% GST to 0%. And when it comes to health insurance for senior citizens, health insurance premia should be exempted completely from, again, 18% to 0%. And for non-senior citizens, they've carved out two categories. For cover up to 5 lakh rupees should be exempt, and for cover beyond 5 lakh rupees should be taxed at 5%. Again, these two categories were currently charged at 18%. So there's a huge potential revenue loss that is going to happen. And to make up for that revenue loss, they have proposed a special rate of 35%, which will be over and above the existing slab of 5%, 12%, 18%, and 28%. Now, to be seen, interestingly, over here is whether the council accepts this proposal or not. And secondly, what happens to the cess? Because already 28% plus cess is applicable on tobacco products and aerated beverages. So will this 35% mean that it will be now 35% plus cess? That is something that we'll have to wait and watch for.
All right. Timothy, thank you very much for that. So that's a big story of the day, the proposals with regards to GST revisions. Just want to highlight NTPC Green, which is now limit up. It's up 10%. And that is, it was a late bloomer this morning, but I mean, it's fully bloomed now. And it's the biggest volume-led gainer across the board in the market. And the other two stocks, right? KPIT and Tata Elxsi. These are the IT from the ER&D space, engineering research space. 6% on Tata Elxsi and KPIT Tech, which is up about 6% as well. So these were not there in the mix earlier, but they are strong gainers. Two other names which were not in the mix. So, oh boy, this is turning out to be an interesting broader market day. HEG and Graphite. HEG is up 9% and Graphite is up 6%. So again, same space, similar sort of business profile, and both are sharply higher. A recent listing, I mean, actually the top gainers list is entirely, it's rotated. I mean, the big movers of the first 10 minutes are completely gone, and it's a new set now. Niva Bupa is up 9%. It's a recent listing, and that's up at about 81 odd rupees or so. So just a few names here which are sort of gaining big. Mitesh is with us with what he'd want you to do with some specific trading ideas. Mitesh, over to you.
Prashant, the market is going strong, so I have a buy on City Union Bank. It's already cleared and, got past the previous swing high. So this should see more continuation logically. Buy here with a stop at 180 for target of 189. The other one is Angel One, which I would, recommend buying with a stop just below day's low. So keep a stop at about 29.30 and look for a target of around 31.50 over the next few days.
Okay, all right. Angel and City Union. Thank you very much, Mitesh, for that. We take a quick commercial break here. Markets up 60 points. Bank Nifty doing better. Manisha puts the spotlight on commodities on the other side. Stay tuned.
Welcome back. All right, let's put the spotlight on the commodity space. Manisha is here. Manisha, what's top of mind this morning?
Well, I'm looking at the crude oil prices because this is one of those rare sectors which is ending 2024 into negative. So putting a spotlight onto this one and with a sense that it isn't really going to turn around and you wouldn't see a positive 2024 for the crude oil prices. So WTI and Brent, there you have it, 5 to 7% of a decline in this year until now. And what really went wrong? Well, a lot of things really. And top of the mind really is China, where we kept on seeing weak economic data, weak oil demand and imports throughout the year, except for the month of November, where the imports have jumped up. The other thing has been the global inventories, which have been on the higher side. The strength in US dollar was a norm in this year, and that has weighed on many of these commodities. And even with whatever output that we are seeing, the world still has 8 million barrels of spare capacity on a daily basis, and that has been keeping the prices under check. If you look at the overall markets, well, for 2025 as well, some of these things could perhaps be overspilling. And add to that the fact that you would be looking at increased oil supply from OPEC, from non-OPEC, from US as well. The production just has been increasing there. And then the China demand growth and stimulus is going to be yet another factor that 2025 will watch out for. The other thing to look at really is about the pace of energy transition and EV adoption, on what numbers we could see going ahead. The Iran nuclear production is yet another thing that the US is watching out for. And then as the US President-elect Trump takes seat into January 2025, there are three things that he could perhaps approve. One, of course, is the trade tariff. Second is the export permits for the new LNG projects there, which he already has spoken about. The other thing is about increase in oil drilling offshore as well as on the federal lands. And most importantly, it also is going to be about the new funding to replenish the strategic petroleum reserve. Going forward into 2025, and most of the reports from global banks and brokerages already are in. And it's quite a broad range, really, that you're talking about in 2025. City Ward 1 is the most bearish on crude, $60 a barrel of an expectation. Bank of America talks about 65, and then you have the 70s club as well. JP Morgan believes that 73 of an average is what you could see in the next year when it comes to Brent crude oil prices. EIA, Goldman Sachs are talking about 74 to 76, and then you have UBS as well talking about $80 as a possibility as well. So when you look at all of those reports and numbers there, it does seem like 60 to 80 is a big range that the crude oil prices could see yet again in 2025.
Manisha, thank you very much for that. So that's commodities in focus. 70 points on the Nifty, 24,344. Time for a break. Our special segment, it's economy, market masters. Lata will be speaking in conversation with Vetri Subramaniam of UTI AMC to discuss where's the market headed now, expectations from the RBI from a stock market perspective, and of course a peek into 2025 according to Vetri. Stay with us.
Welcome to a special Market Masters with Petri Subramaniam, the Chief Investment Officer at UTI Mutual Fund. Well, lately the markets have had so many adverse news thrown at them. Low single-digit earnings growth in Q2, foreign fund exodus after the Trump win, a terrible GDP number that reinforces modest consumption and underwhelming capex growth. And yet, look at the Nifty, up 20% for the year. The small caps and mid caps are actually up between 25 and 33%, if I'm not mistaken. Of course, the Nifty has fallen about 8% from its September end highs. But does that make it more attractive? More importantly, how will 2025 pan out? For all these questions, like I told you, Petri Subramanian, Chief Investment Officer at UTI AMC, is with us. Petri, good morning. Thank you very much indeed for joining us. Let me start from my comfort zone. This GDP number, yes, it's lagged, but it gave us a little more bad news than I thought the Q2 earnings did. What did you take away?
Morning, Lata. Good to be here. Well, I'd say, as you pointed out, the GDP number is coming out with a lag compared to the high frequency data we were getting during the quarter. We'd already had some senses from companies during the quarter that, things were moving at a slow pace. One, because of extreme heat wave in some cases, then because of the monsoon, and few companies saying, look, the pickup that we expected post-election isn't really happening. So I think a lot of this was already baked in and known to the market because of corporate commentary. And therefore, the only market which reacted, more as a surprise to that GDP number was actually the bond market and the currency market. Because remember, that's the market and that's the market participant, which is the RBI stroke MPC, to whom the growth and inflation number is part of the policy-making toolkit. And which is why you actually saw the bond market react dramatically to the collapse in, reported GDP growth, as well as the currency then start to weaken, given the fact that it sets the RBI on some sort of a liquidity enhancing, and the MPC as well at some point having to worry about the growth outcome of its policies.
Mm-hmm. So what are you expecting from the Reserve Bank day after tomorrow?
Very tough ask, Lata, because I think, the governor in particular, I think for more than a year and a half has been reiterating the fact that their target is actually 4%. And one should not just look at the band, but with inflation sitting at the top end of the band, I think it would be a very brave thought process for the MPC, though mind you, there are dissonant voices within the MPC to actually do a policy rate cut now in the current meeting. But, the OIS market is now a lot more comfortable with potential cuts in the rates over the next 2 or 3 policy meetings, and I would tend to go with that. But the RBI does have room to look and take a relook rather at its policy, both in terms of what it's having to intervene in the currency market and what's happening in terms of interbank liquidity. So I think I do expect some action from them to at least target an improvement in interbank liquidity in the short term.
Okay, no, but what is it for stock investors? Would you therefore want to buy banks, big banks, any bank?
Good question, Lata. Honestly, financials and the big banks in particular are something that we felt positive about. It's one of the few areas of the market where we think there is a very clear case for absolute, positive outperformance relative to the benchmark over the medium term. So that continues to be something that we are, quite positive about. I think, just to go back to that question that you asked earlier, I want to make one more point here, which is that it's not just the RBI's actions, and I'm talking RBI, I'm not talking MPC. It's not just the RBI's actions in terms of interbank liquidity, which are material. The RBI, in one sense, has been forcing down a slowdown in credit, maybe for all the right reasons, but this has been ongoing now for more than a year, both through their direct intervention by raising risk weights on certain categories on loan, taking company-specific actions in many cases, and essentially signaling to the market that it was unhappy with the growth of unsecured credit. Now, this might be for all the right reasons, but the fact is when you turn off that tap, it does have some impact on the economy in terms of credit availability and therefore demand growth.
Okay. Well, one would argue that too much of money was going to people who perhaps would not repay at all, and so it had to be called. I mean, the MFI defaults, unsecured loan defaults, are telling you that story, so maybe it was not a bad thing. Okay, I'm more interested in what the stocks investors want to know. Let me come to 2025, really the reason why I called you. Does it look like we are going to be able to repeat this kind of, I mean, 20% is a good performance, even if it is, 8% off highs. What does 2025 look like?
I think still a challenging time in terms of equity returns. I do think we've borrowed from, the future in terms of the returns that we've enjoyed over the last year, or for that matter, over the last 2 to 3 years. Because remember, equity market performance has been way ahead of earnings growth. So there's been a significant PE multiple expansion, and some of that amounts to bringing into the current or bringing into the past returns from the future. So my expectation is a lot more muted. Very quickly, Lata, we do run an internal model for asset allocation, which feeds into our asset allocation strategies. This model was at about 45% equity allocation. Think about the broad range as somewhere between 40 to 80% equity allocation. So it was pretty much at the lower end. Into the sell-off, it's moved up from 45 to about 52%. But in some senses, it's still below even the halfway mark relative to equity allocation. And that tells you all you need to know in terms of, our view in terms of the current tactical attractiveness of equities relative to bonds. We actually think the carry on bonds is still quite attractive relative to where the equities are, certainly with the 1 year horizon.
Okay, no, that's really telling. Okay, let me come to what you like within equities. You did say that you like the big banks anyway. Tell us about the other sectors. I mean, the ones that have done best in 2024 itself are the EMS companies, e-commerce, all the cutting edge. Would you still go after them?
I think honestly, Lata, outside of the banking and finance, it's a lot more stock specific at this point of time rather than sectoral. Simply because I think we are seeing a lot of mixed cross currents at this point of time. And really, therefore, what we would like to focus on is a little bit more of focus on picking stocks based on the fact that these are companies which have the cash flow and the ability to navigate through what could potentially be a slightly more protracted, challenging time, rather than focusing on narratives. But at a sectoral level, honestly, I must admit, outside of banking and finance, I don't have strong conviction at a sector level. Individual stocks and sectors and into this sell-off, certainly some of them have started to pop up, but I wouldn't really have a sector to throw at you. Just one final point I'll make. If you think about the market in terms of a spectrum between quality growth and value, the last 3 years, value has had a brilliant run. But I do think this is a point in time where the pendulum is shifting mildly in favor of quality growth, simply because I think too much of what's in the value bucket has seen valuations rise significantly. And secondly, too much of that is about narratives rather than actual outcomes.
Okay. I'll just move away from sectors for a minute. Would you think that we have to brave this FII outflow for some more time? Have you met people, investors? What's the sense you're getting? Yesterday's number was, fortunately, a small number. Should we believe it is petering out? The big FII sell-off we saw October, November.
I think there are two things feeding into the FPI sell-off, but again, this is very much a generalization because every FPI is different. They're not a homogeneous set of investors. But I think the two things that really stand out with most investors is that one, at a very asset allocation level, the yield that the US bonds are offering means that there is a flow into US bonds as compared to any other asset class. And that's pulling market money out of EMs back into the US. And the second one is that the US, which is now almost 2/3 of any global benchmark, is just very, very attractively placed, at least in the opinion of most asset allocators. And therefore, that's becoming the default market, which is sucking out money from everywhere else. Finally, when you look at India on a valuation context, and this is relevant when we talk a lot about investors who've had experience of investing in India over many, many years and over cycles, I think just the relative valuations of India relative to other emerging market opportunities, it is pretty much the priciest market along with the US market.
Definitely.
Just means many of them are choosing to take a backseat. So it's the pull of US yields compared with the premium valuations for India, which is causing them to stand back. I don't think it is anything of a top-down macro negative call on India. I think most foreigners that we speak to, and we do market to a lot of them for the international monies that we manage, I think most of them understand the long-term structural case for India. They just want a better entry opportunity.
Fair point. Now, the guy who has stood out or braved this selling has been the domestic investor. How are you looking at this trend of superb retail investment entry? Is it a secular one? Or is it that this guy has entered at a good time in the market, and if there are modest returns, as you point out, in 2025, this counter wind of retail investments may peter out, may plateau?
Lata, one of the interesting things that I'm experiencing over the last year in particular is how much of market conversations have shifted to the fact about flows. All my trading as an analyst in all these years, it was about picking stocks based on their fundamentals. And suddenly I find people only want to discuss flows as a means of understanding what will happen in equities. And I think that's completely the wrong perspective. It's wonderful that Indians are participating in equity markets. I've never experienced this in my career, so it's good that they are participating, but that does not become the source of a bull market. A bull market is based on how companies are doing, and we need to be cautious about valuations getting ahead of themselves, because that means you're eating into future returns. Secondly, we talk so much about demand, Lata, because that number is published every day. But if you care to do the hard work of looking at supply, just rough cut numbers that I looked at the end of October, there was about $54 billion of net buying by domestic institutional investors, including mutual funds. But look at the supply. IPOs, QIPs, FPOs, sell downs by PE, VC, promoters, 52.5 billion. And we're not counting everything because there are limitations to how well we can count supply. So my simple point is, it's great that there's demand, but for heaven's sake, also look at the supply. You can't just analyze the outcomes for markets based on flows. Healthy capital market for sure, but I think eventually equity markets are slaves to earnings, not to flows.
Oh, that's excellently put. Great lesson for not only 2025, but for all time. Thank you very much, Vitri. And I must say that we have saved our blushes. I started by asking you sectors and stocks and went into flows as a last resort. And to be fair, CNBC has done a goodish bit of work on the amount of equity sell downs and equity raisings that have happened today. Take your point entirely, and thank you very much for an enlightening conversation. Well, with that, we wrap up on Bazaar. Chartbusters coming.
Shares of ITC and Varun Beverages are down about 1.5% after sources tell CNBC-TV18 that the GST Council is likely to mull a 35% special GST rate on tobacco and aerated drinks.
Torrent Power is up close to around 4% as sources tell CNBC-TV18 the company has launched a QIP worth around 3,500 crore rupees to sell 4.5% equity at an indicated price of 1,503 rupees per share.
Solar Industries up over 3% after its subsidiary receives defense product orders worth nearly 2,000 crores over a period of 4 years.
MOIL gains after announcing record-breaking manganese sales in November. The sales are up by close to 32% year-on-year at around 1.33 lakh tons. The stock is still down 40% from the recent peak.
Food delivery giant Swiggy is up around 3.5% ahead of its results today, the first since the company got listed on the exchanges.
Hello and welcome to Chartbusters. I'm Nigel. With me is Mangalam. And as we speak, the markets have got past that crucial 24,400 odd mark. The Nifty Bank as well is powering ahead. The last couple of sessions, it had a bit of a consolidation, but now the Nifty Bank has taken off. It's leading the Nifty higher. And now we're at a very, very crucial juncture because the Nifty last week went numerous times to 24,350 to around 24,400. But as we speak, we're trading mildly about those levels. So the bulls will feel they have the momentum. They'll want to push home the advantage.
Absolutely.